Who's awake? That's pretty good. Who's not awake?
They're all asleep.
Who's not awake and raising your hand? Okay, no. All right. I'm very awake, obviously. All right. You. This is going to be the most exciting presentation of your life. Well, there you go. I talk fast. It's a good time to practice English. Because if you can keep up with me, you're awesome. Now, I'll go slow and repeat myself. And if it goes too fast, let me know.
We jump right now to topic in development.
Okay, so good afternoon, everyone. I normally cram this presentation down into 10 minutes, but it really needs 2 hours. To actually have a full hour to go into it is a luxury I haven't had for a long time, which is nice. I'll tell you right now, because people are already doing it, you are welcome to sit in the audience and take pictures of the slides, but I will email this to you upon request. It's no problem. It's on my website. You add me on LinkedIn, you'll get the deck, all that good stuff. So you're welcome to take pictures if you want, but I'm happy to send you the deck. So this is the master session, raising unlimited investor capital in the USA with what's called Reg D. So who likes money? Who says, I don't like money, forget it. I'm in blockchain because I love atoms or something. Okay, cool. So anyways, again, I'm happy to send you the deck. You're welcome to take pictures, but there you go. Okay, why am I giving this presentation now? Why am I giving a presentation about raising money in the USA? Would you guys say that this event is well attended right now? Looking around? I'd say it's medium. Why? Because ICOs have dropped off. Why? Because the regulators have woken up to a certain extent. So all those graphs you see about the amount of money being raised in ICOs right now, there was a big increase last year, and then it's been sort of dropping off. What those graphs don't show is all the money being raised privately outside of ICOs for blockchain projects. There are billions, seriously billions of dollars being raised privately, and this presentation is explaining how that's happening, at least in the United States. And the reason I'm giving this presentation also is the SEC, which is the United States' securities regulation body, the Securities and Exchange Commission, just a few days ago indicated that they're going to get even more aggressive with ICOs and other token sales that are not compliant. This is October 11th. Notice it says US SEC gets tougher with crackdown on ICO-funded startups. Tougher, and they're already being tough. And who saw this article where it says the blockchain party is over? This is in Medium. He's not actually saying that blockchain's over, he's saying the party is over. I hope that's not true, because I got a few more parties left. But the idea is that the time when people could just write white papers, raise money, and go have fun and dance is over. We're now at this sort of the build phase. So let's talk about what this is all heading towards. So let me gauge the audience. And again, I talk in sort of fast legal English. If this goes too fast, raise your hand, tell me to slow down. It's not a problem. Okay, so who in the audience has been or is a founder of one or more crypto or blockchain startups? Who's a founder? Who wants to be a founder? Everyone wants to be a founder, come on. Okay, who's invested in one or more crypto or blockchain startups? See, it's interesting, investors are founders. There's some exceptions, okay. Who's raised investor money globally, like outside of the United States? Who's took in investor money? We got Mr. Gibraltar in the back there, probably raised a lot. Who's raised money inside the United States? Who wants to, because that's where the money is? Okay, good, right answer. Okay, who's concerned, by the way, do we all know SEC, Securities and Exchange Commission? Yes? Everyone nodded, yes, we know the SEC. Okay, who's concerned about the SEC? That doesn't mean afraid, that just means concerned. Good. You should all be raising your arms. Okay? All right, and then who's heard about or used what's called Reg D? Got it, some people. Okay, fine. Oh yeah, the final one is who's going to not raise their hand no matter what I say? There you go. Oh, there's a little sort of a trick question there, huh? Okay. Now, there was this sort of French New Wave film movement back in the 70s and 80s where the French New Wave films would show you the end of the film first, like the conclusion, the final scene, and then the whole movie would be showing how you got to that part in the movie. Okay, it was very trendy. So French New Wave films showed the end of the movie first, and then the whole movie was showing you how you got there. This presentation is like a French New Wave film because I'm going to show you the last slide in the presentation now, okay? And the whole presentation is going to explain how we get here. And just like that French New Wave movie, it won't make much sense now, the final scene, but when we get there at the end, it will make a lot of sense. Okay, so here's the summary of this whole presentation. Do use something called Regulation D, specifically Rule 506C, to conduct what's known as a private placement of securities, a private placement. And here's the good part, and raise unlimited capital. What? Unlimited capital from an unlimited number of accredited investors. Use Reg D, Rule 506C, to raise as much money as you want from as many investors as you want. And you can do this legally in the US. You do need to verify, and that's a key word, you need to verify that these investors are actually accredited. And I'll explain what this means. Don't, as in do not, take their word for it. Don't mess around with unaccredited investors. Don't mess around with what's called bad actors. Okay, and we don't mean like bad actors in movies. And don't make any misrepresentations of material fact or omit such facts when offering or selling securities. Okay, we're done. We can go home. No, okay, thanks for saying. Okay, so that's the final scene of this movie. Now, here's a neat little graphic I worked on for like an hour one night. Why do companies raise capital at all? What's the point? Why do we even talk to investors? Well, if you look at traditional economic theory, you have a business opportunity or you have an economic opportunity. That's an enterprise opportunity plus risk. And various inputs on the left-hand side are necessary to make that opportunity come to life. Traditionally, you would have land or labor or machinery. In a more modern sense, you have ideas, you have automation, you basically have productive assets. But the secret sauce for making enterprise opportunities come to life is investment. It's capital. That's almost always necessary to make a company work so that it can grow and make profits, or so a platform can be successful and tokens can appreciate in value. So you need investment. If you're a company from before the blockchain time, you would get investors, they would put in money, they would either lend money to the company, i.e. there'd be debt, or they would buy shares in the company, which would be equity. That's sort of the top part there. This is the traditional model. You'd have investors, they put in capital into the business. If they want the profit, they would get equity. Under the newer model, investors put in capital into the business, but rather than getting equity necessarily in the company, they get tokens that they hope will appreciate in value. And if they are promised tokens before they're functional, they may get something called a SAFT. Who's heard of a SAFT? Simple Agreement for Future Tokens. Okay. So whether you're lending money to a company and getting paid interest, or buying stock in a company, or getting pre-functional tokens, or getting SAFs, these are all securities. That's the key word. These are all securities. And the sales of securities everywhere in the world is highly regulated. Right? What everyone's afraid of with the SEC and all these other regulators is that they're all concerned about the fact that they've been selling securities incorrectly, and now the regulators are awake and they're sending out subpoenas and bringing lawsuits and doing all kinds of mean things. All right? So let's talk about what the rules are and the exceptions to the rules. Now, I give literally 1 hour classes on what the heck a security is. What's a security? What's the difference between my eyeglasses and a stock? What's the difference between an orange and a bond? What the heck is a security? I mean, a security kind of means an investment, but where's the line? You can go on and on and on about the topic, but this is my short version. A security is the legal interest which an investor receives in exchange for contributing capital, i.e. money, or something else of value to an enterprise in the hopes of realizing a profit or other economic benefit resulting from the enterprise's success, but, I should really underline that, but, where such outcome is not guaranteed and the invested capital is at a risk of being reduced or lost. Basically, a security is an investment contract. Right? So if I buy a car from Toyota and I'm driving it down the street and I pay Toyota money, I gave Toyota my money, but the car is not a security. I'm not sharing in the economic risk of Toyota. My car doesn't pay me dividends when Toyota does well. Okay? A security is when I put in money into a company because I want to get profit in return, because the company does well, but where I'm taking a risk because the company may not do well and I may not get my money back, some or all of it. That's a security. All right. Now, securities regulation all over the world, but especially in the US, is perceived as complex and scary. Right? It's highly regulated everywhere, especially in the countries where the money is. United States, Europe, and so forth. And in the US, the laws are even more complex than they are in Europe and other locations. So people get nervous about raising money in the United States. So why bother raise money in the US? Why bother with US investors? The law is complex. The SEC is mean. If people think, well, why? Well, because that's where the money is. Okay? I've worked on many, many, many deals. US investors want to put money into blockchain projects. They want to put money privately. They're actively interested. Also, when you do an ICO, when you're selling your tokens, that's a marketing event. It's not just a chance to raise money. When you're selling your tokens to the world, whether it's an ICO or in some other pattern, it's a way of letting your customers, your future customers, know about your platform. So you really shouldn't get away from selling into the United States. That's where the money is. That's where your customers are. You kind of need to deal with it. And in reality, even though the default rules, even though the default regulation of security sale in the US is tough, is kind of hard to deal with, there's many exemptions or exceptions to those rules. And I'm going to explain how this works, where you don't need to comply with the default rules, where you can take advantage of one of the exceptions, and it's really not that bad. So I participated in deals where people raised tens of millions, if not more, by not following the full rules, by doing an exception, and they've been very successful. And this has been for blockchain companies. Okay, so there's so much law on securities, but the 5 basic laws that form the foundation of United States securities regulation are these. You got the Securities Act of 1933, the Securities Exchange Act of 1934, and 3 other laws I'm not going to go into because the 2 core laws of this 5 are the Securities Act of 1933 and the Securities Exchange Act of 1934. Those 2 laws, since 80, 90 years ago, formed and still form the basis of securities regulation in the United States. Now, most other countries on the planet have 1 securities law. Why do we have 2? Because if you look at the year, 33, 34, that's the Great Depression. World War II was going to start. Everyone was kind of busy. So they couldn't finish all the law in 1933. So they just did some of the law. And then in 1934, they finished what they couldn't do in 1933. All right, so your 2 key laws that govern security sales in the United States are the Securities Act of 1933 and the Securities Exchange Act of 1934. And I'm going too fast, too slow? Thumbs up, thank you. Okay. Who's not gonna raise their hands no matter what? You. And you, sometimes. Okay. Okay, so now for this talk, we're gonna be focusing on the 33 Act. That's what's called the Securities Act. Okay. Yep. And let's say hello to the Securities Act. Hello. Now, if you go to my website, which is cryptolawpartners.com, you can download the 33 Act and the 34 Act. It's available for you to download. And we got some nice little sections that we're going to cover in this presentation. It's easy there. Look at the very top, where it gives the point of what this law is. And basically, the purposes of the Securities Act are to provide full disclosure of the character of securities being sold and to prevent and punish fraud in the sale of securities. That's the point of the 33 Act. Now, what does that actually mean? What does the 33 Act actually cover? Let's get some terminology straight. If I'm a company or I'm a blockchain startup, I'm going to jump down. How you doing?
Great.
What's your name?
Sam.
Sam?
Yeah.
Gordon. So I have a company. Let's call it Cryptotech. Okay? And I want to raise money. And now I made the poor camera guy stand up. Sorry, buddy. This is an active session. Okay? So I want to raise money. All right? And I'm going to sell you my stock or my tokens or my SAFs. I'm the issuer. Okay, that's the term. I'm the issuer. And that first sale to you, the first buyer, is called a distribution. Okay? I'm the issuer. It's a distribution. Now, sir, what's your name? One more time? Fam? Fabrizio. Fabrizio. Just say Fabrizio. Let's go. Now, it's Sam. If I sell my stock to Sam and he gives me money, okay, I'm the issuer. I raised money. I can now start my business. If you two make a deal between each other, okay, that's not a distribution of stock. That's what's called trading. Okay? You guys are just investors trading amongst yourselves. So my first sale to Sam is covered under the 1933 Act. Okay? The 33 Act is when the initial issuer of stock makes that first sale because it wants to raise money. What happens afterwards, you sell to you, you sell to you, you sell to you, all that other stuff, that's underneath the 1934 Act. So the 34 Act is called the Exchange Act. The 33 Act is called the Securities Act. Makes sense. Will you buy my stock for my cool blockchain startup? Please. Oh my God, really? You know it's 2018, right? Okay, cool. Will you buy the stock from him? Probably not. Maybe at a discount, right? Okay, cool. All right, we'll keep going here. So when a company sells its securities the first time to raise money, that's a distribution. I'm the issuer. What happens later is trading. The 33 Act, which is the one we care about, is you want to set up a blockchain company, you want to sell tokens or securities, raise money, and start your business. You're the issuer. Okay, this is people trying to understand U.S. securities law when they first come up with it. Who has had this expression when thinking about U.S. securities? Come on, you all have. Okay, why? Because the default rule underneath the 1933 Act, the Securities Act, the default rule is that when an issuer sells securities to Sam, that under the default rule, you have to file what's called a registration statement with the SEC, and you have to file a prospectus with the SEC. Both of those need to get approved, and this whole process can take months, and it can cost hundreds of thousands, if not millions of dollars. Okay, that's a big pain. That's called an IPO, an initial public offering. Okay, and generally, unless you're Google or unless you're Apple, you don't want to do an IPO. Right? That's the default rule. And on top of that, if you do file a registration statement with the SEC, if you do file a prospectus with the SEC, and you do an IPO, you're now a publicly traded company. So underneath the Securities Exchange Act, that 34 Act, you have to comply with all those rules. 99.99%, you don't want to do this. All right? And this is all pursuant to what's called Section 5 of the Securities Act. Now, thank God, there's some exceptions. Section 3 talks about exempted securities. There's some things that we sell that are securities. They are investments in enterprises. But the government has said, even though they're securities, we're not going to regulate them. So for example, if the United States government sells bonds, which are securities, in other words, sells debt to people, the US government does not need to register its bond sales with the SEC every time the US debt goes up by $1 trillion. Okay? So that's 3A2. Any security issued by the United States or territory thereof or any state does not need to be registered with the SEC. Here's an interesting one. 3A4 is if a nonprofit, i.e. a charity, is selling securities, and it's a true charity, it does not need to register with the SEC. So think about all those private foundations like Ethereum that are selling their tokens. Are those securities? Maybe. Do they need to register with SEC? Maybe not if they're a nonprofit foundation. That's kind of interesting. And I'll keep going here. Now, here's the one that really is awesome. There's exempted securities, which is the last slide, or previous slide. Then this one is exempted transactions. So with this, they're saying, yes, you're selling securities. Yes, normally you would have to register with SEC, but there's certain transactions, certain sales, where we're not going to apply this rule, where you don't need to file the registration statement, where you don't need to file the prospectus. Oh my God, that's great. So let's look at this. 4A2. The provisions of Section 5, meaning the need to register and pay all that money and spend all that time, shall not apply to transactions by an issuer. Remember, I'm an issuer. Not involving any public offering. In other words, how you doing? What's your name? Otto? Adam. Am I saying that correctly? Okay. If we've known each other 20 years, you were best man in my wedding, and I'm selling stock to you, is that a public sale? It's probably a private sale, right? I'm selling stock to everyone who's forward of the white wall, but no one else behind. Is that a public sale or a private sale? Private? I don't know these people. Are you sure? Well, then you're a great lawyer if you're sure. What I'm getting at is public sales, private sales that are not public sales do not need to be registered with the SEC. But you have some cases that are clearly private. You have some cases that are clearly public, like if I offer to everyone, but there's these weird middle zones of, I don't know if this is private or this is public. I don't know, I just met you guys. I don't know if this is private or public. You know, we don't have a pre-existing relationship. You don't know my business. You weren't best man at my wedding. Who knows? All right, so theoretically, 4A2 was awesome. See, I actually said awesome. All right, because under 4A2, again, an issuer can avoid the entire registration process required by Section 5 by not engaging in a public offering. In other words, by doing a private placement of the issued securities. But what exactly does that mean? Where's the dividing line between public and private? Well, until 1982, no one knew the answer. So people would go to court, and they'd fight with the SEC, or the SEC would sue them, or people would call their mother or their senator, and they would try to figure out and say, please, God, provide us with some guidance about what the heck a private sale is and what the heck a public sale is. And the courts, before 1982, came up with all these factors to try to figure out whether or not a sale was public or private. Now, can you imagine how annoying that is if you don't know whether you have to, when you sell stock, whether or not you need to register it, whether you have to look at these factors and try to figure it out? There's like, was the offer made to a small number of people? Were they sophisticated? Was there general advertising? Was enough information provided? Did he get a chance to talk to management and ask questions? Was the transaction confidential? All this stuff. You know, was it one of these factors? Was it all these factors? Was it a balancing test? Who knows? Finally, in 1982, the SEC said, we don't know the answer either. But we're going to come up with some rules. And those rules are going to be collected in what's called a regulation. A regulation is a grouping of rules. And Regulation D, like I said, is a cluster of rules, which are rules 501 through 508, that the SEC came out with in 1982. And they said, we don't know what the heck a private sale is or what a public sale is, but if you follow these rules, you're safe. You do not need to register your sale with SEC. Right? I'm going to be real clear about this. The default rule in the US is when an issuer does that first sale, you have to register with SEC under Section 5. That's what's called, in legal English, that's called a big pain in the ass. Does everyone understand big pain in the ass? Okay. Registering with SEC under Section 5 is a big pain in the ass. File a registration statement, file a prospectus, all these changes, it's a big waste of time. Luckily, Section 4A2 says for non-public sales, you don't need to worry about that. What the heck is that? We don't really know. Reg D said, we don't know either, but so long as you follow these rules, we're going to treat this like a private sale. That's great. So you're exempted from registration under Section 5. Now, let's pick up on something I kind of skipped over. One of the factors that the court looked at to tell the difference between a public sale and a private sale is the second bullet point there. Was there no general solicitation or general advertising of the offering by the issuer or its agents? What the heck does that mean? Well, if I am claiming that I'm doing a private sale and I don't need to register, it kind of looks weird if I take out an ad in the Wall Street Journal or do a website or advertise on TV that I'm selling a security. That's not really a private sale. I'm kind of advertising to everyone. Does that make sense? You know, you'd want, if you have a private sale, you kind of want it to be confidential. You wouldn't want too many people to know. So one of the factors the court looked at is how many people knew about the sale. And going forward one slide, under Reg D, here's the rules that make it private. But something magic happened in 2012, 2013 that changed everything. Mr. Gibraltar, you want to hear this? Go, tap the guy on the shore. This one you want to hear. I know, okay. So there's a new rule called Rule 506C. This is a gift from SEC God. This will save you millions of dollars in lawyers and let you raise all the amount of money you want from American investors. Okay, so let's cover Rule 506 generally. This is a rule under Reg D. Rule 506 is the rule you want to generally use under Reg D. It's a private placement under 4A2. In other words, it's a private, non-public sale. These are exempted from Section 5 registration. There's no limit on the offering size. All that stuff you hear about, you can only raise 5 million or 50 million or 100 million, none of that applies. You can raise $400 quadrillion and you're still okay. Okay, you can raise all the money on the planet and you can use this rule and not have to register your sale. You can raise from an unlimited number of accredited investors. It's not 35, it's not 50, it's not 99, it can be 7 billion, so long as they're all accredited. Unlimited funds for an unlimited number of accredited investors. You have to file something called a Form D with the SEC, and I'll talk about that in a minute, but it's not hard. You have to watch out for something called a bad actor, which is a disqualification danger. We'll talk about that. The stock you sell is restricted, which means you can't turn around and quickly resell it, and the management has to be able to ask questions, or management has to be available to answer questions. There's two variants of Rule 506. There's B and there's C, but these lists of factors at the top apply equally to B and to C. Make sense so far? I'm looking for nods. Yes? Blue suit? We good? All right, thumbs up. Yes? Okay, cool. Now, what the heck is an accredited investor? Remember, I said you can sell to an unlimited number of accredited investors. And remember I said something about you have to verify that they're accredited? Okay, so here's the idea. The whole point of Section 5, the whole point of that registration statement and prospectus is to make sure that people have enough information that they can make an intelligent decision about whether to buy a stock or to sell a stock. Right? The government's not making a decision for you. They're just making sure that you have enough information. So a registration statement and a prospectus is a structured document that the SEC approves to make sure that you're telling investors enough so that they can make a good decision. Now, think about that. That's the government basically acting like your mommy. You know, making sure that you have enough information. What if you don't need the government to help you? What if you have a brain and can ask your own questions? Well, it's hard to know whether or not an investor has enough of a brain that you don't need to give them the formal registration statement or the actual prospectus. So what the government does is say, rather than testing to see whether or not someone has a brain, we figure that if they have enough money, they either have a brain or they can hire someone who has a brain, and then they'll be safe. So basically, in broad terms, an accredited investor is someone who has enough money that they either have a brain, or if they're an idiot, they can hire someone who has a brain to figure out whether or not an investment makes sense. Who's an accredited investor? Any one of these things apply. If they've made over $200,000 for the past 2 years, and it looks like they're making $200,000 the next year, we assume they have a brain. If they have over $1 million of assets, net worth, not counting their personal residence, we assume they have a brain. Now, if property in Barcelona is anything like property in Los Angeles where I live, of course, residence doesn't count, having $1 million residence doesn't mean you have a brain. It just means that you own a house, because it's an expensive market. All right. If the investor is a general partner, officer, or director of the issuer, we don't assume they have a brain, but we assume that they know about the company. I mean, they are the president or the officer or the director. The government doesn't have to tell them what kind of information they should have. And some other examples. And again, I can provide the deck. So 506C applies. You can sell to an unlimited number of accredited investors. Here's the top of a Form D. Remember I said that under 506C, you have to file a Form D with the SEC. Now, this is really interesting. Remember, under Section 5, you have to do a registration statement, you have to do a prospectus, and the SEC needs to approve it. The SEC does not need to approve this, okay? It is a notice of exempt offering. Notice it says notice. It's not a request. It's not an application. It's not a dear SEC, please approve my offering. You're just letting them know that you're doing a private placement of securities. Now, this form is about 4 or 5 pages long, depending on what you add to it. Some people look at a Form D and they're like, oh God, I can't fill out a Form D. Well, from my point of view, if you can't figure out how to sign a Form D or how to fill out a Form D, you have no business selling securities in the first place, right? Believe me, if you're selling securities and taking people's money, you should have enough intelligence, or your lawyer should, so that you can figure out how to fill out a Form D. Okay? There's an expression in English, we call it a Darwin test. Right? If evolution stops you here, then you're going to be weeded out by natural selection, and you won't be able to raise securities. Okay, now recall that one of the issues with 506C is you can't have a bad actor participating in your sale. Okay, what's a bad actor? Well, a bad actor is certain kinds of people involved in your business that have had what's called a disqualifying event. Okay? If any one of what's called a covered person in your business, and I'll explain what this means, has had a disqualifying event, then you cannot use Reg D, and you lose the exemption, which is kind of scary. Okay? If no one's been a bad actor, then you don't lose the exemption. So what the heck is a covered person, and what is a disqualifying event? Okay, here's some kinds of covered people. The issuer is a covered person. Any executive officer or director of the company is a covered person. If someone owns 20% or more of the stock of the company, it's a covered person. Anyone getting a commission on the sale of the securities is a covered person. So there's this group of people out there that the SEC looks at to see whether or not they've done anything bad that would make this exemption go away. If the company has a janitor or a secretary, that person's not a covered person. We care about the people that are in charge, the people that are on this list. So what's a disqualifying event? What does a covered person need to do that's bad that makes them lose the Reg D exemption? If they've been convicted of a felony or a misdemeanor, i.e. a crime involving security sales, then that's a disqualifying event. If they're under discipline from the SEC or a stock exchange, that's a disqualifying event. Now, here's something that's interesting. If I commit securities fraud in the United States, that's a disqualifying event. If I commit securities fraud in Barcelona, that's not a disqualifying event. The only kind of disqualifying events that count are ones that happen inside the United States. So if I'm here in Barcelona and I cheat a whole bunch of investors and I'm mean to my mom and I go to jail and all that other stuff, I can go to the United States, start a company, use Reg D to raise money, and I'm not a bad actor because all those bad things I did in Barcelona don't count, at least for this rule. So the lesson of the story is if you're going to commit a crime, do it in Barcelona. No, the lesson of the story is that doesn't make you a bad actor. Now, when you're dealing with this, the bottom line is because having a covered person doing a disqualifying event can make them a bad actor and then you lose the exemption, you really, really, really don't want that to happen. So you want to do investigations, check people's backgrounds. You want to get representations. In other words, you want them to sign things saying that they didn't do anything bad. And you want to add provisions to your agreements where they let you know if any kind of bad event happens. Okay, now, remember I said there's 506, and this applies to 506 in general. But then there's 506B and 506C. By the way, you guys with me? Give me nods, give me thumbs up, give me thumbs down. I see nods, I see nods, I see. See, you said you wouldn't raise your hand, but you're nodding, which is awesome. Okay, cool. So there's 506B and 506C. 506B is the way Reg D used to be until 2012, 2013. Remember I said now there's unlimited accredited investors? Well, under 506B, you could have up to 35 unaccredited investors. People who we weren't sure had a brain or could hire someone who had a brain. You only had to believe that the other investors were accredited. You could not advertise. You could do all this. Basically, 506B stinks. 506C is awesome. That's the one you care about now. You don't want to sell to any unaccredited investors. You need to make sure that they have over 200,000 every year or have over $1 million or whatever. You need to verify that they're actually accredited, and I'll explain what that means. Now, here's the most beautiful thing on the planet. You can advertise your security sale. Okay, you can put up a website. You can send out emails. You can let the whole world know that you're selling securities, which actually, when you think about it, is crazy. Notice I put right here, wait, what? Under 4A2, remember 4A2? On which 506 is based, non-public offerings don't need to be registered, right? The whole point of Reg D is that this is a private sale. Well, if it's a private sale, why are you allowed to advertise to everyone? Does anyone have a good answer? Because the law says so. It's great, okay? So in 2012, 2013, the law changed. And this private sale is not really a private sale anymore. You can offer for sale to the world. You can advertise to the world. You just need to make sure, and here's the trick, you just need to make sure that the actual sale is only to accredited investors. So I can put up a website that every single person on the planet reads and goes, oh my God, I want a cyber blockchain coin. But you need to make sure that you only sell to actual accredited investors. That's beautiful. You can put up a website. You can advertise everywhere. Okay, this is the best thing on the planet. All right, now, remember I said you need to verify that they're accredited. You can't just take the word for it. So let's do a test. Sir, what's your name? Mark? You were saying that. So, Mark, just remember, one of the accredited investor criteria is that you have to have over $1 million net worth, not counting your residence. So you do have over $1 million net worth, not counting your residence, right? Say yes, say yes, say yes. Okay, you know what? Even though you're going no, I believe you because I choose to believe you. Okay, that's called self-certifying. He lied to me and I chose to believe him. No, just kidding. But self-certifying is when the investor says that he qualifies and gives me the reason, I can take your word for it. I can choose to believe you. Well, that's okay if you're not advertising to the whole world. But what the SEC said was, or the Congress said was, if you're going to advertise to everyone, if you're going to take advantage of 506C, I can't take Mark's word for it because I don't trust you. So I need to see documents proving to me that you have $1 million in net worth, or documents showing me that you have more than $200,000 income for the past 2 years and for the next year. Tax records, something signed by your accountant, something signed by your lawyer, brokerage statements, is something. Now, I don't need to go crazy for it. If you forge a document, if you make up a document that's not true, it's not my fault. But I need to verify that you're accredited. Now, that sounds a little bit painful, but there's lots of services out there that will verify for you if an investor is accredited. You don't need to do it yourself. There's like verifyinvestor.com is one of them, started by this guy named Jor Law. All right. So you can sell to an unlimited number of accredited investors. You just need to confirm that they are verified as accredited. And here's a final note. I kind of skipped over it, but under 506C, you're not technically, actually let me go to the right place. Under 506C, you're not technically required to disclose all the information about what you're selling. You're not required to provide an offering memorandum or information memorandum or to explain what the heck is going on. Now, who thinks it's a good idea to sell security without explaining what the security is? Good, no one raised their hand. Someone kind of raised their hand. Okay, why would you want to explain all the facets, all the factors about your security, even though you're not required to? Because the way the law works, under US law, and this is true almost everywhere, what's your name, sir? Michael. Michael, if I tell you, remember I said I was in Barcelona and I committed securities fraud and I was mean to my mom and all this other stuff? Okay, do you think that's important to your investment decision? Potentially. Right, I'd argue probably. So that's like a material fact. Now, it's true that all this stuff does not make me a bad actor because it didn't happen in Barcelona. It didn't happen in the US, and because the US is crazy and thinks that way. So it doesn't make me a bad actor. But if I don't tell you about this, you buy the securities, you buy the stock, but then you can't sell them because no one wants to buy stock in a company where the president was convicted for fraud. That's pretty serious, right? You might sue me because I didn't tell you this. Right? You might. Like, you might feel okay with buying the stock. You know, it was a bad day, I was getting divorced, I was on drugs, I was drunk, I didn't mean to do it. Okay, you feel sorry for me, right? That's your decision. But if I don't tell you and I'm taking the decision away from you, or I lie about it, it wasn't securities fraud, I was jaywalking, right? That can get me in trouble. That gives you grounds to sue. The basic rule of securities litigation is that people cannot sue you for the things you tell them that are true. And, or to put it another way, they can only sue you for when you lie or when you leave out important information. If I disclose everything important, no matter how bad it is, so long as they know about it, they can't sue you on the basis that you didn't tell them. Right? So basically, you want to say everything bad about yourself and the company to investors, because everything bad you tell them that they know about is something that they cannot later on turn around and sue you for. So you better believe I'm going to tell you I got convicted for securities fraud. Because if I tell you and you buy it, you can't sue me later when you can't resell your stock. Now, is that a problem for me? Are you less likely to buy it? Sure. Okay, but that's an argument I took away from you. Right? So when you're selling securities, even though you're not formally required to disclose all this stuff, even though you're not formally required to have a disclosure document, you better do it. Right? Take the weapons away from your enemy. All right, now, again, French New Wave movie, and I'm doing this much faster than an hour because, you know, end of day, we all want to go for tapas and drink something. Sir, do you want tapas and drinks? What? Okay, look, I'm new to Barcelona. I'm getting the vocabulary. Do you want some sangria? Me too. All right, so I did this hour presentation in like half an hour. But again, French New Wave movie. Do use Reg D, specifically Rule 506C, to conduct a private placement, i.e. not a public sale, to raise unlimited capital, not 5 million, not 50, not 100, but anything you want, for an unlimited number of accredited investors. And remember, we have the definition of accredited investor. You have to verify that they're accredited. They cannot self-certify like Michael and lie to me about that $1 million. Did I get your name right? Michael? Mark. See, you can lie to me about his name. No, I just forgot, sorry. Like, I can't have him self-certify and lie to me or not. I need to verify that he's actually accredited. So do verify, look at the records to confirm that he's actually accredited. Don't take Mark's word for it. Mark, you liar. Yeah, it's okay. Don't mess around with accredited investors. You know that one guy that has 10,000 euro who really wants to invest? Not worth it. Don't do it. Okay, one accredited investor stops you from using 506C. One. Now, why would you mess around with an unaccredited investor? You wouldn't. They have no money. Okay, let them go invest in stocks. Don't mess around with bad actors. In other words, someone who's important in your company, who's done a bad thing, been convicted for a securities felony, or is under discipline from the SEC or from an exchange. Don't mess around with them. And the big one, the last one, this will save your life every time. Don't make any misrepresentations of material facts or omit such facts when selling securities. In other words, tell the truth, tell the whole truth, tell nothing but the truth, and the SEC won't get you. And that's it. That was efficient. I'm impressed with you guys for sticking this out. This was technical, and this was fast. Okay, and again, I am more than happy to send the deck. I'll send the deck. Happy to do it, take pictures, but I'm happy to send the deck. Questions? By the way, I think I heard beginning of a clap. You can clap.
Yeah, can we all stand up and give him a hand of applause? You know,
Yeah,
are we
securities
still
law,
awake?
exciting
Are we
stuff.
still awake?